If you're shopping for a home in 2026, you might be budgeting the wrong monthly payment. And the surprise isn't your mortgage rate, it's property tax. Because after you buy, your home can get reassessed and your monthly payment can jump by $300, $500, even $800 a month. Today, I'll explain what reassessment is, why it hits new buyers the hardest, and how to estimate the real monthly cost before you buy. Quick disclaimer, property tax rules vary by state and county. Use this as a framework, then verify details with your local assessor and your lender. Most buyers anchor on one number, P and I. That's principal and interest, the part you pay to the lender. But your real monthly housing payment is often PITI, principal, interest, taxes, and insurance. And here's the trap. Listings and calculators often highlight P and I because it looks lower. But taxes and insurance are real money, and those numbers can change. In many places, the biggest change comes from property taxes after reassessment. So what is reassessment? Reassessment is the local government updating the taxable value of the property. In plain English, what is this home worth now, and what should the tax bill be now? In some areas, it happens on a schedule. In other areas, it's triggered by a sale, renovations, or other events. Here's why buyers get trapped. Longtime owners may have a much lower assessed value than today's market value, so the tax bill you see online might reflect the previous owner's situation, not yours. When you buy, that assessed value can reset closer to an updated number. Result, property taxes go up. And if you pay taxes through Escrow, that becomes a higher monthly payment. Let's make it real. You find a home listed at $300,000. You run a mortgage calculator and get a principal and interest payment that feels manageable. Then reality shows up. Property taxes vary wildly by location. In some places, the monthly tax might be $250. In other places, it could be $500, $700, or more. Homeowners insurance also varies by zip code and risk. Don't be surprised if it's $150 to $300 plus per month in many areas. And if you put less than 20% down, you may also have PMI. Now here's the reassessment punch. If the current tax bill works out to $250 a month, but after you buy the home is reassessed and the taxes become $550 a month, that's a $300 monthly jump. That jump is brutal because it's not optional. It can turn a comfortable payment into constant stress. And it often feels even worse in year 2 because of Escrow. Many lenders collect taxes and insurance inside your monthly payment. They hold that money in an escrow account and pay the bills when they're due. At closing, the lender estimates taxes and insurance. But if reassessment kicks in or insurance rises, that estimate can be wrong. Then the lender runs an annual escrow analysis and discovers a shortage, and you may get hit twice at the same time. 1. Your escrow portion increases because taxes are higher. 2. Your escrow portion increases again because you're repaying the shortage from the prior year. That's why people say, my mortgage is fixed, so why did my payment jump? Because your interest rate didn't change. Your taxes and insurance changed, and escrow adjusted to catch up. So how do you protect yourself before you buy? Here are the 4 steps that matter. Step 1. Stop using the current tax bill as your future tax bill. When someone says taxes are only $3,000 a year, ask, is that based on the current owner's assessed value or my post-purchase reassessed value? If they don't know, assume it could go up. Step 2. Look up the property's tax and assessment history on the county website. If the assessed value looks unusually low compared to today's market reality, treat it as a warning sign. Step 3. Build a rough estimate. Use your expected assessed value after purchase and the local tax rate to estimate an annual tax, then divide by 12 for the monthly impact. Your goal is not perfection. Your goal is to avoid being off by hundreds of dollars a month. Step 4. Get real insurance quotes early and ask your lender how escrow adjusts if taxes rise. Now, one document forces the full picture, the loan estimate. Early in the mortgage process, you'll receive a loan estimate form. On the first page, look for projected payments. That's the lender's estimate for your full payment, not just P&I. But look closely at what they assumed for taxes and insurance. If those numbers look low, ask whether they're using current taxes or expected post-purchase taxes. Also, get loan estimates from more than one lender. Sometimes the difference isn't the interest rate, it's how taxes, insurance, and fees are estimated and structured. So here's the takeaway. P&I is not your payment. And the biggest hidden landmine for buyers in 2026 can be reassessment, because reassessment can raise property taxes. Property taxes raise escrow, and escrow raises your monthly payment. Before you buy, don't ask, "Can I afford the mortgage?" Ask, "Can I afford the full PITI after reassessment with a buffer?" Comment your state and county, and I'll show you where to find the right tax info and how to estimate the monthly impact. And if this helped, subscribe.